What's up, everyone? I'm back at it again. This time I'm looking at another stock today. Now, before I get into it, why am I building this account? Well, pretty simple. I'm building this account for a bridge account for retirement. And what is a bridge account?
If you want to retire before then, let's say at age 50, or at least have the ability to do that, you can utilize a normal savings account or a bridge account, which essentially is a non-retirement investment account that you can use to float you until you're old enough to tap into the retirement account.
What are my requirements for my dividend portfolio? Well, I have a very simple requirement. One, it has to pay dividend. Two, it has to be a good growth stock. And three, it has to be good financial standing. Now, if you don't know what a passive income is, this is what a passive income is.
This. You take money that you can afford to go to zero and you put them into two places that have historically created passive income. Public markets that you don't care if it goes up and down and you just wait to the end, or real estate and you hope that your real estate area doesn't get crushed. Everything else almost doesn't exist.
The reason why I invest like this is because of what Warren Buffett said.
I had the whole wrong idea. I was interested in watching stocks, and I thought stocks were things that went up and down, and I charted them. I read books on technical analysis. I read Edwards and McGee. I think that was the classic then. Hundreds and hundreds of pages. And I read that whole thing over and over again. And I read Garfield, Drew, I read everything. And I thought the first 8 years, I thought the important thing was to predict what a stock would do and predict the stock market. And then I read Ben Graham, when I was 19 or 20. And I realized that I was doing it exactly the wrong way. But
now, like and subscribe to my video, and let's get into this video.
Never buy a stock that doesn't pay a dividend. That has been your advice through and through. Why are these stocks more attractive?
You look at companies that don't pay distributions, don't return capital, how risky they are. Take a GoPro, for example. I'm not just picking one company, I'm just giving you a good example of a company that basically has lost 70% of its value, never returned a dime to shareholders. Or how about a company that's been around much longer, Yahoo? Never paid a dividend. It's never made money for anybody except all the CEOs that have gone through there and got whacked.
Look at Realty Income, ticker symbol O. Now, I've been looking at this. This is a monthly dividend company, and it looks like it's pretty good to have because a lot of people talk about it. Well, what are they really? I can't really listen to everyone else because sometimes people just go with the hype. Just because it pays a 5.4% dividend yield and pay monthly does not mean it's good to add to the portfolio. Their portfolio, let's see what they have. They're everywhere, it looks like.
Company. This feature is beloved by investors, forming a cult following around the company. 1969, the company had the goal of using revenue from net leased real estate assets to provide monthly dividends that increase over time. Realty Income would
feature property clients. So they're real estate with Treasury Wine, St. Barry, 7-Eleven, Lowe's, and Chipotle. Okay. Looks like they're mainly in commercial real estate right now. All right. Yeah, it looks like they're mainly into commercial. So let's move into what it really is.
Buy across tenants, industry, property type, and geography. Realty Income has a diverse tenant roster aimed at reducing portfolio risk. Walgreens represents 6.
So let's look at the stock and see what the growth was for last year to date. Year to date is 5.3 or 10%. And the 1 year is down negative 5.39%. 3 years it is 13.19%. And 5 years is down 7.38%. And the max is up 606. Now, looking at that, it doesn't look like the growth rate is very good. But let's look at the dividend income real quick. So the dividend yield is 5.49% or annually 3.23%. And they've been paying for 21 years. That's pretty good. They've been paying out pretty Um, well, and they have a pretty high dividend yield, 5.49. So yes. So let's see what the finance does and how is it been growing, declining, to see if it's even worth it. Because the growth, of course, the chart doesn't look like it's going to be there for a little bit. It looks like it's on the decline. So 2017, they had 1 billion. 2021, they have 2 billion. And now they're up to 5.27 billion. Now, if you don't know why I like using MSN, if you don't know what revenue is, you can click on this side and say investor measure growth on how fast the company revenue sales is growing year over year. And right now they increased by 29% from 2023. So they grew to 5.29 or 5.27 billion. All right, the other thing I like to look at is what's the gross margins. Well, they have a 92.84% gross margin. That's pretty good. With a net profit of 16.45. That makes sense because they had to give back a certain amount of income due to being a REIT. Let's look at the balance sheet. So intangibles 11.26 billion long term, and shareholder. They don't really give us current asset, fixed asset, or liability. Let's look at the cash flow. That's very interesting. They only have 189 million in cash flow. In years before, they were negative 5 billion, negative 6 billion. Okay. Investment cash flows in the negative. Operation cash flow is 3.57 billion. That's how much it costs to operate it. Yeah, this financial cash flow is negative 21.16 billion. So that means the cost of rise of capital such as share and bonds that the company issue or loan is taken out. Yeah, the finance doesn't look too great to me. They look like they finally got to the positive, but man, they had years and years of negative equity or negative cash flow. Let's look at what the analyst says real quick. So earnings is 0.22, 3 years is 0.29, and the REIT is 1 year average 1.15. Okay. Let's see. Earnings. It looks like it's been missing its forecast as earning, which, okay, they don't look too hot now. Let's see what investors are in there. Well, Vanguard, BlackRock, State Street, they're all in here. Okay, so they're very big companies. Let's see what companies are leaving. All right. By looking at all that, let's go into AI to see if it's even what's going on, what's the AI thinks about it. So AI, the valuation is a 1 out of 6. Let's see why. Side Street, Reese. Earning is 860. Price to earning. It trades above industry standard. And the PE ratio is 56.68, above weight average to its peer at 23.43. So it's way above that. The earnings, man, where is it? Right, oh, right here. So the earning realty income is a negative 24.14% for growth versus the peer. Future growth Yeah, I can see this future growth, but I can't really trust what the future growth is going to do on this one because too many people hyped up this stock. Historical performance, it's 4 out of 6. That's understandable. And financial health is two, 2 or 3 out of 6. It's below its peer average. Makes me, yeah, it doesn't look too good. Personally, it misses, yeah. All right, let's get into the nitty gritty. And will I buy this stock? No, I'm not buying this stock. It looks like they're mainly in commercial, and commercial right now is hurting. In the last 3 to 5 years, this stock has been going down. It does pay a good 5.49% dividend, but I'm not here just for the dividend. I can't have my stock go down 5% every year or even 13% every 3 years because I will be breaking even from the dividend payments. So 5.39 and the dividend payments 5.49. Okay, you're pretty much breaking even on this stock. And I'm here for the growth. Now, this is a good stock to have, but I think there's better REIT you can get with a better financial number. Now, their finances doesn't look that great. They do have a good gross margin and a net profit, but they do not have a good cash flow situation. Looks like they're always in a negative, and I don't like seeing companies always in a negative. So, this is my opinion on it. You know, they're a $1 billion company or $5 billion company, and they only have a free cash flow of 189 million. And the years before, they were 5 million or 5 billion debt, 6.2 billion of cash flow, 1.1 billion. That just doesn't go well for me. The It doesn't show that they're doing very well. And with AI giving it roughly a, let's see, 0 out of 6, 3 out of 6, 5 out of 6, 4 out of 6, 2 out of 6, it's giving it about 3 out of 6 for a stock. It doesn't make it worth it for me. There's other REIT that I can purchase that will give me a better return, and this one right here doesn't seem like it's gonna be a good one. And right now, like and subscribe to my video, and that's all I got.